Hi, everyone. Thanks for joining. We're going to give it a few more minutes just for everyone to get in and settled, and then we will start. All right, thanks for joining, everybody. We'll get started. So, thanks for joining 2021 year-end tax planning for law firms and attorneys. Just a little bit of housekeeping. The webinar is being recorded. We will have a 50-minute session today with 10 minutes at the end for Q&A. Our questions will be addressed at the end, so keep an eye out for that. Please send in your questions by typing in the questions pane of the GoToWebinar panel. And also the slides and recording will be emailed after the webinar. Our presenters today are Dan Mayo, Principal and National Lead in our Federal Tax Policy team, and Jonathan Weinberg, Senior Manager in our Professional Services team and our State and Local Tax Services team. So with that, I will hand it over to Daniel for our federal tax update.
Great, thank you very much, Alexandra. And so thank everyone, thanks for being here. It's I see a lot of familiar names on the attendee list, so welcome back. We've spoken many times on Teams. This is a somewhat more formal platform, this GoToWebinar. So if you have questions, you do have to present them through the question format. I am monitoring that, so I'll try and address questions real time if there are any. Not, we can address them at the end of the panel. So, and Jonathan can too. So feel free to submit your questions through the platform here, and we'll definitely receive them. So we're going to start today with sort of an update on where we are in the legislation. This is the big unknown, the big uncertainty for year end, and how it affects your planning. The next slide, please. And so there's been a lot of back and forth. There've been you have the President's Green Book. You have a couple versions of House, the Build Back Better bill. You have the White House framework came out. There've been many proposals. Sort of, rather than give you I only have 15 minutes here for my portion, to give you the background, the history, we just go right into what's left. And so what's left in the proposals, where we are at this minute, is 5% surcharge for people making more than 10 million. Again, proposal. This is a proposal. And 3% for those, so two more brackets, 10 million and a $25 million bracket. The CBO is supposed to provide revenue estimates this week, I think tomorrow. So in the House, and Pelosi, Speaker Pelosi is committed to getting a vote on this bill by Thanksgiving. Don't know if that will happen, but that's the latest in terms of timing. Though we see here the top rate would be 48.8%. Again, that's for someone making over 25 million a year. They are including an expansion of that state and local tax deduction limit. Currently, it's 10,000 as a result of the 2017 Tax Cuts and Jobs Act. That would they were talking about expanding that to, one proposal was 72,500, another one was 80,000. Almost the minute this thing came out, putting this in the bill, Senator Sanders came out and said he disagrees with this and he won't approve for anyone. So his latest proposal, which they're working on, which may come in, is you make under $400,000, there's no limit. If you make more than $400,000, you're stuck with the cap or possibly no deduction for state and local taxes. So what they would do is they would also extend this out for 5 more years. I recall it was 6 years rather. It was due to expire in 2025. This the deduction limitation, so they would push it out. It's going to cost a lot of money. It's been said that this has a very high price tag on it. Qualified small business stock is something we see a lot in the tech industry. This is where companies, a shareholder who sells stock in a C corporation can exclude up to 100% of their gain, up to 10 million or 10 times their basis. It's called Section 1202 or qualified small business stock. It can result in millions of dollars of savings for people for whom it applies. There's a 50, 75, and 100% exclusion percentage based on the time you purchase your stock. So if you bought it before 2009, somewhere in 2009, it's 50%, and then up to from 2009 approximately to 2000, I think 15 rather, it's 75%. If you acquired your stock after 2010, loosely, there's actual dates in there, some are mid-year. You have 100% exclusion percentage. So the proposal would get rid of 75 and 100% exclusion rate. So everyone making over 400, the best you can get is a 50% exclusion. Now, this is the one piece that's going to be retroactive of all these proposals we're going to talk about. This is the one that will have retroactive effect when the date the House introduced this legislation on September 13th. We're talking about amending the wash sale rules and the constructive sale rules to include digital assets like cryptocurrency, non-fungible tokens. The wash sale rule, just to remind everyone, is something also to think about at year end. Occasionally, we get clients who are hit up for a couple $100,000 a year in taxes based on the wash sale rule. If you sell a stock and you buy it back within 30 days, your loss is disallowed and it's added to the basis of the replacement stock. So this really trips a lot of people up if you're a frequent trader, and this can trip you up. The solution to it is you make a mark-to-market election for the following year, and then you don't have to worry about the wash sale rule, but that's out there. Constructive sale is when you own a stock and you don't want to sell it. You see, let's say you want to borrow against it and hope to pass it to your heirs tax-free under the step-up and basis rules. Constructive sale rules come in and say if you hedge that stock in certain ways, like a short against the box, you're deemed to have sold the stock even though you didn't actually sell it and you have to pay tax at that point. So that's some additions there. They want to bring cryptocurrency, which is a big initiative of the IRS, within the ambit of the wash sale and constructive sale rules. They're also talking about adding commodities and currencies to the wash sale rule. It's sort of surprising that they haven't been included to date, but they're sort of thinking of putting it in now. Net investment income tax is at 3.8% tax. That's going to be, they're going to expand the base so it includes active income earned from a trade or business for taxpayers over 400,000. It does not include active business income today. And then the last one here for the individual provisions is an extension of the excess business loss provision. For those of you who are tax people, it's section 461L of the code. What this does is it limits excess business losses, so the excess of business gain over business loss for individual taxpayers, essentially. There's a limit that extends until 2025 because it came in as part of the Tax Cuts and Jobs Act. Right now, there's a threshold. You can deduct up to 250 of excess business loss if you're single, or 500,000 married. That goes to those numbers raised in 21. They're a little bit higher. I think it's like 260 and 520, something like that. They're talking about permanently extending this. It would apply forever. It won't sunset in 2025. And they're talking about eliminating that threshold. So you wouldn't even get the first 250 or 500,000 of excess business loss. You get nothing. So this would be a pretty significant change if enacted. Next slide, please. Some retirement provisions. I'll skip the first one. It applies to when we give Roth IRAs or regular IRAs over $10 million. They want to stop the Peter Thiels of the world who have this $5 billion Roth IRA. And what they're trying to do is saying is that if you're over 10 million, they're going to limit your ability to contribute, and they're going to require you to take minimum distributions of significant amounts to bring the balance down and pay tax. If it's a regular IRA, not if it's a Roth, you just have to take it out. You don't get the deferral going forward. So those are the first two bullets. Then they're going to eliminate these backdoor Roth conversions. So this would be the last year of 2021, which is a nice strategy for people who make too much money, more than the Roth limit. They can't contribute to a Roth, but you can still, they call it the backdoor, because what you do is if you have a 401k or an IRA, you contribute the maximum pre-tax amount, but then you contribute after-tax funds up to the maximum allowable limit for the year. So usually you can put, if you're, let's say you're 50, you can put 19.5 in your 401k. You can put another 6,500 in as a catch-up because you're 50 or older. Then you take that 26,000. The maximum you can put in a 401k is 58,000. So you put the excess in with after-tax funds. You don't get a tax benefit, but when you put those after-tax funds in, you can then roll those over into a Roth 401k. And so you have money in a Roth that you couldn't otherwise get in there. And the benefit is not on the setting it up. The benefit is going forward. You now have after-tax funds in a Roth that are going to grow tax-free for forever until you take it out. So that's a way to get money in that back door. They're going to shut it down this year. So it's a good strategy. If you haven't done it before, you might want to take advantage of it this year. Try and get some extra funds in a Roth IRA. They're going to eliminate conversions. Right now, there's no income limit to convert a regular IRA to a Roth. You do pay the tax, of course, but there's no income limit. You can pay the tax and get your money into an IRA, which is a Roth, which is great because then you have future growth tax-free. This provision won't kick in for 11 more years, you see there. So there's plenty of time to get this done if you still want to do it. And then there's a prohibited transactions tax for IRAs that hold a FISC, foreign sales corp, or domestic sales corp. Sort of provision there to get at some cases where people did some abusive trades. Next slide, please. On the business side, large corporations with income over $1 billion would have a 15% minimum corporate profits tax on their book income. This is because of the perception here. What they're trying to crack down is companies report large book income to the shareholders, but no taxable income to the IRS. And so what they're trying to say here is that they're going to have a minimum corporate tax. Stock buybacks is the next one, 1% buyback for publicly traded U.S. companies. Again, the concern here is these companies have excess cash. They could have distributed it in the form of a taxable dividend to the shareholders. Instead, they buy back the stock, which increases the value of the stock, because when you have less shares outstanding, the earnings per share goes up, and therefore the value of the company. So they're giving the sort of shareholders tax-free value by doing a buyback. And so this is intended to tax that. The next one here is something I put in because I thought it'd be of interest to the group. If you are a plaintiff's personal injury firm doing a lot of contingency fee cases, or even non-personal injury, but doing contingency fee cases, this puts you on a cash basis for purposes of the cases, so you can deduct your expenses, your out-of-pocket litigation expenses as you incur them, rather than capitalizing them into the case and deducting them at the conclusion of the litigation. So nice provision here. I guess a nice lobbying on behalf of the plaintiff's lawyers to get this included. There's also a host of international tax provisions. We could easily spend the full hour just on them. So I'll skip over that to get to some more stuff that I think will be more relevant to this group. Next slide, please. This is eliminated provision. So what's not in tax reform, right? We've heard so much about all the back and forth. Some things come in, they come out. I thought it was important to tell you what's going to be in there, but also what's not in there. So you've heard it in the back of your mind. You're like, I know this was out there. What's the status? Well, here's the status of the things that are not there. The no rate increase. So the top rate will remain 37%. Individual rate will not jump to 39.6. No increase in the corporate tax rate. It's 21% is the C Corp corporate tax rate today. There was talk of making it graduated, putting an 18% rate, 21, then 26.5. That's going to go away, so it stays 21% flat tax. No increase to the capital gains rate, long-term capital gain or qualified dividend income rates. They're staying at 25%. They will not jump to 25%. No changes to the carried interest provisions for hedge funds, real estate funds, private equity. So that's helpful for that industry. No, they were talking about putting a cap on the qualified business income deduction, which is they're not going to do that. This next provision would have affected probably some law firms out there. To convert from when an S corp gets large, they have more than 100 shareholders, it no longer qualifies an S corp. This was a provision that would have allowed a 2-year grace period where these corps could convert to partnership status tax-free. Absent this provision, if an S corp wants to convert to a partnership, it has to liquidate and then pay the tax and then form a partnership. Alternatively, it could just put its assets into a corporation, into a partnership rather, and all future partners come into the partnership. There are ways around it, but it doesn't solve for the existing shareholders of the S corp. There's no mark-to-market tax for unrealized capital gains for billionaires. This was a billionaire's tax. This has gone away. would have been difficult to administer and confusing and somewhat unfair and perhaps not even constitutional. So that's not going to be in the mix. And no elimination of the step up in basis on death. This was a huge one. And also no change to the estate and gift lifetime exemption. It will remain 11.7 million per individual this year. It's scheduled to drop though to I think 5 million or 6 million in 2025. So it will come down on its own. So they're not talking about changing that provision. Next slide, please. So I have a very brief, another minute or two I'll use up, and then turn the floor over to Jonathan so we have time for questions at the end. You'll see I have another 10 or 15 slides here. I purposely put more slides in than I knew I would have time to cover, knowing that we've disseminated these materials through the webinar. They're in the handout section when you look on the go to webinar. So you'll have them and you can look at them and contact me or whoever you're with a professional is and ask questions if you have them. But this runs through a gamut of ideas the goal is here is to defer income and accelerate expenses, which is the general advice for most people. The only time you don't want to do this is when rates are going up next year, so those high net worth people, if you make more than 10 or 25 million, there's those new tax brackets that will kick in. So you would not want to defer income if you're going to be in those brackets. If you're not going to be in those brackets, right, $1 paid tomorrow is worth less than $1 paid today. So you're better off deferring income, accelerating your expenses, which has the effect of deferring your income tax. We have here many ways to do it, many different things. So lots of ideas here. We also on the coming slides have ideas on how to accelerate expenses. So feel free to go through these and we can either ask questions, we can discuss them at the end, or we can talk at a different time. But I want to leave time for questions at the end and for Jonathan. So with that, thank you. I'll turn it over to Jonathan now to continue the discussion.
Hey everyone, so we're going to kick it off talking about pass-through entity taxes. So if we could skip forward to the PTET slides. Okay, so let's go back one slide, or forward one slide. So the first question is, why should law firm partners care about pass-through entity taxes? And the reason for this is that there are traditional prohibitions on practicing law in corporate form, which means that overwhelmingly law firms need to be structured as pass-through entities, which can be an LLP, a partnership, LLC, S Corp. All of these entities are generally not subject to federal income tax. Instead, it's the owners pay the income tax on the firm's profits on their respective distributive shares. Furthermore, most states traditionally conform to the federal treatment of pass-through entities. So essentially owners pay state income tax on the partnership's profit. And again, as a result of the TCJA cap of $10,000, many law firm or pass-through entity partners or owners don't get a full deduction for their share of the state and local taxes associated with their ownership interest in the firm. So moving to the next slide. So what precipitated the pass-through entity workaround? So obviously we have the TCJA SALT limitation, and a bunch of states came out with some other workarounds, like the charitable deduction workaround, payroll tax workaround, and the IRS quickly shut those down. But then there were a couple early states that adopted pass-through entity taxes, whereby the entity would pay the income tax at the state level instead of the owners. In particular, Connecticut and New Jersey. And then at the end of 2020, the IRS issued notice 2020-75, which said that the IRS found pass-through entity taxes to be a valid business deduction of the pass-through entity and essentially blessed pass-through entity taxes. Now, this is done essentially in the middle of the presidential transition as the Trump administration was on there. The IRS issued this notice. There's some feeling that this was rushed by one administration in order to bind the successive administration. And it is possible that the service could come out with a different opinion when they finally issue regulations regarding pass-through entity taxes. But again, according to IRS notice 2020-75, pass-through entity taxes are valid. So moving to the next slide. So again, pass-through entity tax is a growing trend for the states. Before the limitation, the TCAJ had the $10,000 SALT cap. Again, the pass-through entity tax, the idea behind it is fairly straightforward, that you impose an income tax directly on the pass-through entity, which takes a valid, ordinary, necessary business deduction for those expenses, thus reducing every owner's distributive share of income, and therefore they only pay federal tax on the after-tax amount, essentially preserving the $10,000 deduction for the owners for other taxes like real estate taxes. Moving on. Now, one thing to keep in mind is that pass-through entity taxes have been adopted by states at a very rapid clip. If you look at states going over to, say, market-based sourcing or single-factor sales, these are changes that have taken decades before we got to a plurality of states adopting changes like that. Here, if we look at the adoption of pass-through entity taxes, we look at the summer of 2020, and in 2020, Connecticut had a mandatory pass-through entity tax, New Jersey had adopted one, Maryland, Rhode Island, handful of states, Michigan was considering one. But again, not many states had adopted. So now we go to the next slide, and we're basically gonna watch the blob. So all of a sudden, we get to April 2021, and New York and Massachusetts and California, they're all jumping on the bandwagon. Everyone is seeing this as a way for owners of partnerships to preserve their SALT deduction. So this is what the state of the country looks like in April 21. Let's move to the next slide. And again, the blob keeps growing. All of a sudden, Illinois and Michigan and Colorado, most of the southeastern states are in on this. Most of the northeastern states have jumped in on this. So moving to the next slide. So now we're up to August 2021, and again, we see this green blob spreading across the country. I mean, that this is moving so rapidly that as you move from month to month, states are proposing these and enacting them within a matter of weeks. So you don't even get that shift from tan to green. You just have a state pop up in the next month, go to green. So again, we'll go to the next slide. And so now we're up to October 2021. And at this point, a state having pass-through entity taxes is really getting to be more the norm than the exception. There are over 24 states that have pass-through entity taxes. We have to keep in mind some of these taxes are effective for tax year 21. Some taxes don't kick in until tax years beginning on or after January 1, 2022. And again, overwhelmingly, these are elections. So you need to be aware of when elections need to be made. So let's move on to the next slide. So we're going to go into a polling question. We can pull that.
Polling question. So just you'll see it pop up on your screen, and then you can participate.
Okay, so the question is, has your firm considered making a PTET election? So the options are yes, we're making them wherever available. Maybe, considering but haven't made any decisions yet. No, we looked at it and did not see the value proposition. And then finally, we never even heard of PTET until today. So give everyone 30 more seconds or so to answer. Okay, and Alex, can we get the results up?
Yeah, so seeing the results, around 50% has said yes, we are making PTE elections wherever possible. 10% said maybe, 20% said no, and 20% said that they had never heard of PTE election until now.
Okay, well, in that 20%, I'm sure there's going to be a lot of discussions back at the managing partner meetings. And again, with the maybes, in states like New York, the time for electing the PTET for 21 has come and gone. But many states said the election to do a PTET for 21 isn't due until 2022. So that now is the time to be having discussions with your service providers about whether a PTET election makes sense for the owners of the firm. So moving on to the next slide. So risks and consideration. So again, 2020-75 was released under the Trump administration, and it's possible that the Biden administration can rescind or alter the guidance given under the Trump administration. For non-resident owners and resident credits, the resident state of a non-resident member may not allow a resident credit on their individual return for taxes paid at the entity level. In particular, Pennsylvania has said that they will not give residents a credit, residents who are members of partnerships, a credit for taxes paid to other states under a PTET regime. So Pennsylvania resident owners need to balance, well, what is the federal benefit for getting the deduction versus the cost on the loss of the credit. You know, the benefit of a PTET election may require significant state presence. So again, in many states, the pass-through entity tax only applies to state-connected income. So a state with 1% apportionment, there just might not be enough there to make it worthwhile. And finally, that duplicate estimated payments may be required in order to save the deduction. For instance, in New York, a pass-through entity tax payment for 2021 is not actually required until 2022. But if you want to save that deduction in 2021, as we were talking about accelerating expenses, those estimated payments need to be made in 2021. They need to be made by December 31st. So you really have to look at, well, what is the cash flow effect of having to make PTET elections? So moving on to the next slide. So primary features. So again, every state's pass-through entity tax is a little bit different. So there are a number of considerations to take into account typically with any PTET election. So first is it elective or mandatory? So in Connecticut's the only state that mandates that all pass-through entities participate in a pass-through entity tax. Every other state allows partnerships and pass-through entities to elect whether they're going to participate. But then there's questions, are those elections revocable or irrevocable? Next question is eligibility. That is a pass-through entity eligible to make a pass-through entity election? Does the presence of disregarded entities or corporate partners prevent you from making that election? The next question is, well, what is the state tax base? Is it on pre or post apportioned income? Just for example, in New York, for resident owners of a pass-through entity, their pass-through entity election is on unapportioned income, which means that they basically save the deduction on 100% of their income. So there's a huge benefit to New York resident partners for making a pass-through entity election. There's also the question of, well, how does the state make the owner whole for making the pass-through entity election? Do they either give you a credit, a dollar for dollar credit, or something less than dollar for dollar credit for the taxes that were paid at the PTET, or do they give you a subtraction from taxable income? So moving on to the next slide. So again, we have a couple, just a quick list, states with mandatory PTET elections. So Connecticut, DC, New York City, those are mandatory pass-through entity taxes. You know, we have the list of all the other states that have elective pass-through entity taxes. Moving on. Again, we just have a quick sampling of pass-through entity tax rates. You know, in states with highly graduated rates, you know, that oftentimes these pass-through entity taxes are tied to the top marginal state rate, like in New York and New Jersey. Now, since the owners may not actually be paying tax at those higher marginal rates, but in New York and New Jersey, the owners get a dollar for dollar credit for their share of pass-through entity taxes paid. So any overpayment that's getting made as a result of a PTET election, they're just going to get that money back. So again, it becomes really much more of a cash flow management and timing issue, because whatever, if you're overpaid, that's not a big deal. You get the money back. So moving on to the next slide. So this is, I think, one of the most important slides in the deck, and this shows you what the states do to make the owners of pass-through entities whole when they go to file their returns. And we can see that the majority of states give 100% credit for whatever is paid as a pass-through entity tax at the entity level, although that's not universal. In particular, Connecticut, owners only get an 87% credit. Massachusetts, I think Massachusetts only gives a 90% credit. But then on the left-hand side, we have a number of states that they don't give you a credit for the taxes paid at the pass-through entity level. They give you a subtraction income for the income that was subject to the pass-through entity tax regime. So moving on to the next slide. So some other actions going on with pass-through entity taxes. So obviously monitor states for legislation and guidance. Seems like every week I turn around, another state is considering it or enacting a pass-through entity tax regime. I think we're going to see more of it throughout the fall as state legislatures tend to have fall sessions. So we'll certainly be on the lookout for that. It's of course important to model out the potential pass-through entity tax savings in consideration of making the election and balancing that against the potential loss of any credit for taxes paid to a non-resident state, as well as does an entity need to make structural changes in order to potentially maximize or even take a pass-through entity tax? For instance, in California, if there's owners that are disregarded entities, the entity cannot make a pass-through entity tax election. Whereas if those entities became multi-member entities, you could make a pass-through entity election. So again, are there structural changes necessary to take the benefit? Moving on. And that takes us through, we're going right into a polling question, right into on the state tax implications of a mobile workforce. So we'll move into the question. And the question is, what is your firm's policy on remote work? So as your firm decided to go fully remote, gave up the office, going over to a hybrid model where everyone comes in the office a few days a week and works from home the rest of the time. We expect everyone to come back to the office full time, or you're not really sure and you're afraid all your associates will quit based on whatever decision you make. So we'll give a few seconds here for everyone to answer. Maybe just another 30 seconds now, and then we'll pull up the responses. Yeah, Alex, why don't we pull up the responses?
All right. So 11% decided to go fully remote, 56% hybrid, 33% they expect everyone to come back, and 0% weren't sure.
Okay, wow, okay, so it seems like everyone is, at least has made a decision. And to be honest with this group, I don't think those results are unexpected. In many ways, the practice of law does not necessarily lend itself to remote work. Obviously, there are ethical and bar rules around having a bona fide office versus a home office. So firms going over to either hybrid or requiring everyone to come back to the office is a question that makes sense. But let's move into some of the remote workforce issues. So moving on to the next slide. So obviously COVID-19 still disrupting the global economy and transforming workforces. People not allowed back into the office. And states and businesses are all grappling with the state tax fallout from this. So the big issues to consider with a mobile workforce or people working remotely as a result of COVID is income and sales tax nexus, income tax apportionment, and state payroll withholding. So moving on to the next slide. So again, due to licensing issues, the practice of law traditionally required as lawyers to be tied to a specific office. You know, it was really frowned upon to be practicing law in a jurisdiction where you're not licensed to engage in the practice. But again, once COVID came up and everyone was banned from the office and everyone was required to work remotely, many law firm partners, employees use this opportunity to start working from, very remotely. People working from family homes, vacation homes, second homes, people just packing up and getting a long-term Airbnb or a long-term rental someplace else. And, some of these remote work arrangements are ending, and some of these remote work arrangements are becoming permanent. And how work is done is going to have substantial effects on law firms, lawyers, and employees. So moving on. So telecommuting impacts on Nexus. So again, Nexus is defined as the minimum contacts a business needs to have with the state to establish a connection, allowing the state to impose a tax. That once you have Nexus, you potentially have to register, collect, and remit sales taxes on sales made within the state. I will point out there are a couple, 3 states that do impose taxes on legal services, with some exceptions for potentially criminal defense and family law. There could be a requirement to possibly file income tax, gross receipts tax, net worth taxes, and consider pass-through entity taxes. So types of nexus include physical presence, as well as economic nexus, which would include factor presence, which is a defined gross receipts threshold, deriving a certain amount of gross receipts in the state, versus a nebulous doing business. Are you just deriving revenue from sources in the state? So moving on. So COVID-19 has certainly created nexus concerns for businesses due to telecommuting employees. A handful of states have issued guidance that if you just had an employee temporarily working remotely in the state as a result of a COVID-19 emergency, that they were not going to say that created nexus for either income or sales tax purposes. So, but again, those emergency declarations have either expired in many states at this point, or they are going to expire at the beginning of next year. So to the extent that those temporary work arrangements have extended beyond state emergency orders, that having employees working remotely, again, from that family home, vacation home, wherever, is potentially a nexus creating activity, which would force law firms to file returns in states where they traditionally haven't had to file. And again, we need to consider where our remote employees are located and whether that's creating a filing obligation for income taxes as well as payroll taxes. Moving on to the next slide. So again, for income tax apportionment, some states are still using cost of performance apportionment. Some states still include a payroll factor in the measure of the apportionment. So to the extent that if employees have moved away from the traditional office, that could potentially be reducing the payroll factor as well as the sales sourcing in that traditional office. It could also be creating a payroll factor and the cost of performance in the new state where the employee is teleworking from. So again, that's another aspect to consider. Moving along. So again, how do you determine how much income is taxable in one state versus another? If you consider an average state income tax rate is 7%, and if you were taxable in all 50 states, well, if you paid 7% in all 50 states, that would be 350% of 100% of your income. No one can do that. So every state is required to only tax the income derived from sources within the state. And that's the concept of apportionment. So when a taxpayer conducts business in multiple states, every state has to figure out how to divvy up the income and determine how much income is sourced within those states. Historically, states leveraged a model apportionment formula from UDIPA, which used equally weighted property, payroll, and sales factors. But at this point, just about every state is deviated from the UDIPA formula. Some states use double-weighted sales, triple-weighted sales, or even single-factor sales. And I would say at this point, the majority of states use the sales factor as a sole measure of apportionment. And again, states also use different sourcing methodologies. Some states look at where the work was performed to generate the receipt. Other states look at where the customer benefited from the service. And they'll distinguish between individual customers versus business entity customers. So again, as people scatter to the wind and now we're coming back to the offices, this all needs to get sorted out how it affects a business's apportionment formula. Moving on to the next slide. Again, that takes us to our next polling question. So is your firm actively recruiting or hiring remote workers? Our options are yes, we'll now hire talent wherever we find it. No, we are requiring everyone to come back to the office. Only for non-lawyer positions such as admins and paraprofessionals. And finally, we just learned that we have employees in numerous states. So we'll give everyone a minute or two to answer the question. Maybe just another 30 seconds now for everyone to get their response in. Now let's go over to the answers, Alex.
All right, so 71% said yes, that they will now hire talent wherever they can find it. And 29% said no, they're requiring everyone to come back.
Okay, so really black and white. I mean, a lot of firms out there that again, they're open to remote work. They'll hire talent wherever they find it. And of course, whenever you hire a new employee in a new state, that is definitely creating new tax filings, whether it's local taxes, payroll taxes, state income taxes. So moving on to the next slide. So again, just summarizing the factors. So, that again, there's traditionally 3 different types of factors to analyze when it comes to apportionment: payroll, sales, or property. Then you have activity types. So with services, that services sales receipts are either apportioned based off market-based principles or cost performance principles. In states that are cost of performance, you're really going back to, well, what does your payroll look like? Because that is where your cost of performance is occurring for a law firm. Moving on to the next slide. So telecommuting obviously has an impact on payroll taxes as well. So payroll tax withholding requires employers to deduct income and payroll taxes from employees' compensation before their payment to the employees. This is one of those few areas in state tax where people really go to jail if you withhold money from an employee's paycheck and don't turn it over appropriately. States really frown on that. So we definitely do not want to get sideways with employee withholding. Employees may adjust their income tax withheld from compensation by providing a withholding certificate. It's also important to make sure that employees are updating their withholding whenever they move. Now, obviously, there's lots of firms that are in tri-state, multi-state areas. When that employee moves from New York to New Jersey, or New York to Connecticut, or New Jersey to Pennsylvania, they need to let the employer know so the employment tax withholding can get adjusted accordingly. And of course, every location does employment taxes a little bit differently. So the state where an employee principally lives generally has primary tax authority on their income. But for state taxes, withholding from employment is typically based on where the employee works. So typically the resident state will give a credit for taxes paid to the non-resident state. But there's additional complexity to this. First of all, there are some states that have reciprocity rules. For instance, residents of New Jersey and Pennsylvania only pay tax in their home state. They don't pay tax in the state that they work. So New Jersey residents paying tax who work in Pennsylvania only pay New Jersey state tax. They might have to pay Philadelphia tax, but they only pay state tax to New Jersey. Pennsylvania residents who work in New Jersey only pay Pennsylvania state tax. So again, those reciprocal agreements can certainly create complexities. Moving on to the next slide. And then we also have, again, they owe tax to the state from which they work, regardless of the employer's location. So again, some jurisdictions use what's called the convenience of the employer test, or office of convenience test, which means, in particular, in New York and Massachusetts, if an employee is assigned to work in the New York or Massachusetts office, and those employees worked remotely throughout COVID, New York and Massachusetts, as well as a handful of other states, say that they remain subject to tax on all of their compensation in New York and Massachusetts just by virtue of having been assigned to that office, which could really cause some situations where employees are subject to tax in multiple states on the same dollar of income. So again, you also have issues with regards to employees changing their state of residence, that we are now 26 months into what was supposed to be a 6-week emergency. So employees may have been working remotely for years at this point, but they may not have changed their residence because or their domicile because they intend to return back to their old home, but they've been in another state long enough that they're considered a statutory resident. And again, those issues need to be addressed because a resident state can tax an individual on 100% of their income from whatever source derived. And again, you still need to look at work days. Have they hit a threshold for reporting? Different states have different thresholds. In fact, we'll go into that in the next slide. So here we have a quick map that shows, what states are friendly to remote workers and what states aren't so friendly. So a handful of states are somewhat friendly. Arizona, Hawaii, that they allow you to work in the state for quite some time before non-resident withholding is required. But the overwhelming majority of states say that 1 day of work is enough to cause an employer the obligation to start withholding on that employee's wages. So if you have that employee that goes on that 1 day business trip to New York in theory wants their share of tax on that 1 day. So again, as a result of COVID and people scattering to the wind, there's a whole nother set of considerations regarding remote work and where employee withholding is required. Moving on to the next slide. And I think that takes us to our questions.
Yes, we're at the last 2 minutes of the session, so if anyone has any questions, please feel free to submit them into the chat. And Jonathan, if there's anything else you wanted to add.
Absolutely. Can we just back up to the last slide as well with the map? So, again, I mean, where you look at states saying, okay, 1 day, one employee, 1 day worth of work, we want you to withhold, where states may take that position, employers really need to figure out what their line in the sand is going to be. Whether that's going to be 5 days and we're going to start withholding, 10 days and we're going to start withholding. I would say going over 10 days might start to get to be a bit unreasonable. But employers do have an obligation to track employee travel, which again, with law firms, there might not be so much depending on the firm, but depending on the firm, there could be a lot of employee travel. That I have one client that they have employees, lawyer employees visiting 30 states in a given year to handle depositions and are admitted pro hoc vice in various state courts and associating with local counsel. And so they really need to track these employees' locations because it's very easy for one of their lawyers to spend 20, 30 days over the course of a year in a state like Missouri, even though they live and work in New York for depositions and hearings and whatnot. And they need to make sure that they are addressing that withholding appropriately in both the non-resident state, the state where the employee is doing the work, as well as in their home state. So that way the employee can get the home state credit as well. And with that, I think that takes us to the end of the 50-minute hour.
Yes, that takes us to the end of our 50-minute session. So, oh, hi, Dan. See Dan's back on. Dan, if you have anything else you'd like to add as well.
No, it's a great presentation. Thank you.
All right, great. Seeing as there's no questions, we will give you 10 minutes back of your day today. Thank you so much for joining us. We will be sending a follow-up email with PowerPoint presentation and the webinar recording, so that we email out to you all soon. Have a great rest of the day and feel free to reach out to us. Thank you.
Thanks, everyone.
Thanks. Bye.